thank you for joining us today. I'd like to welcome everyone who joined us for the seminar. For those of you who are new to our events, let me introduce myself and give you the overview of what we are expecting to have today. So my name is Lana Veselova. I'm International Partnership Manager at Cbonds company. We are a data aggregator, and additionally we are a conference house arranging on a regular basis seminars and right now online webinars. So today's topic we stated as inflation fears and rising IG, investment grade and government yields. Today's seminar, I will be joined and assisted by Chief Investment Officer from Blackfort Capital, Andreas Bickel. So today we'll cover a few topics which are rather essential for our current situation. So today we'll discuss a bit more comparing to our last seminar around a month ago, the improved global growth outlook. So we'll understand what is the market mood as of today. We'll see the impact of fiscal stimulus. We also try to discuss rising government bond yields and whether US inflation is transitory. At the very end of our seminar today, we'll try to give the overview of the impact on US and high yield markets. And the most interesting part, I like to be very precise. So today's webinar will speak more about some concrete, interesting corporate bond issues, which Andreas had a chance to analyze just recently. So to give you the understanding of better understanding of our speaker, let me give you a proper introduction. So Andreas Bickel has been at the fixed income market for around 26 years of huge investment experience in portfolio management across all the strategies within the top tier investment banks. So prior to joining Blackfort Capital, he was a head of portfolio management of such reputable institutions as Goldman Sachs, Bank, Deutsche Asset Management, and at Rothschild Bank he was the head of asset allocation and advisory. So he's the exact proper person to discuss such investment situation as of today and actually the tactical investment ideas. So I'm happy to introduce and pass the floor to Andreas. I would like to address to each participant who joined us today. So be more active, as you have the unique opportunity to address directly to the speakers. So you are free to leave your questions regarding the fixed income market in Q&A section, so feel free. And after the presentation and our discussion, we'll discuss the most interesting questions from the audience.
Thanks a lot for the nice introduction. I'm pretty fine, although the weather here is like winter. We had 25 degrees 1 week ago, and today is -5, and it was snowing. So I'm more than happy to be at home and not traveling around due to the virus.
Well, I hope only the weather can surprise you such hugely in a huge manner, not the financial markets, actually.
Well, you know, nobody has a crystal ball. However, some things I would argue we have seen pretty well, like high yield markets. Some other things which we come in a second have surprised even me as a positive person, which will be the growth outlook. I think with no further ado, let's try to share the screen and go into details. So again, welcome from my side. Basically, the agenda was already set. So key questions for a fixed income market guy is, are inflation fears overdue? Are we too scary? Or is it, as the Fed puts it, transitory? I don't like personally this word, transitory, whatever that means. I have an answer to that, and future will tell if I'm right or wrong. However, I think it helps to start with what has happened year to date and then try to look forward and reassess what we have discussed in the past. So basically outlook, stimulus, impact on various markets, inflation. And then different to the last several times, we will have as well some examples. I find this simple graph quite surprising. Let's use really this word. I mean, we were, as you probably know, cautious for investment grade and we were cautious for government bonds. But if you were to tell me in December that after Q1, the US corporate market, the first bar on the top, or the US Treasury market, both benchmarks would be down more than 4%, I probably would have doubted. Similar to the broad emerging market index, which is also down more than 4%. More interestingly, as for instance, institutional investor must invest into investment grade. You see at the bottom, you see the global ag and the Euro ag. So investment grade, high quality bonds, both are down roughly 0.5%. In the middle, you see Chinese ag, also high quality. Also this market or this segment of the market is down. And now it comes to the biggest surprise. The pan-European high yield market was outperforming the rest of the world. Nevertheless, US and Asian high yield markets have positive return year to date. And this is rather amazing, given that you have fear of rising inflation, you have definitely rising yields, you have in some emerging markets even rising policy rates, but you were definitely in brackets safe in the high yield market and not in markets where the rating and the quality is giving you some safety. With that, let's turn a bit to the recent back of economic data and the outlook. This chart basically shows you that in China, the manufacturing area has, after a sharp drop in COVID, also sharply recovered and recently is fading, but only the manufacturing part is fading due to the strong recovery in Q2 to Q4 last year and also in Q1 this year. What is more important is you also see on the right-hand side the retail sales or the consumer demand, if you will, which has picked up after COVID and which is now again in a positive area. I would argue this is not really surprising, but if you were to follow the IMF or the OECD forecast for the world and for China, this should rather come as a surprise. And funny enough, just recently there was the new release of the IMF global growth forecast. They had to revise it up, but they are still significantly lower than the figures I have presented last time. I would still argue that their analysts are behind the curve and that we will see more surprises on the growth front going forward. Having said that, to just paint the picture and give you more background, let's start with the lowest figure there with the brown line. That's the manufacturing PMI in China, and you see it is slightly down, slightly decreasing, but still above the 50, which means the growth area. basically what you can read out of this is there is a certain normalization, a certain growth which is positive, but not accelerating. But more important actually is the second line, the purple line. This is the non-manufacturing, so the service area for China. And that one has sharply picked up over the last 2 months. We are now above 55 for those who are new to this. This means the purchasing manager guys expect an acceleration of growth within their company. And the link to the global economy is that based on such indicators, you can derive an acceleration or deceleration of the global economic situation. And if you will, you can even make certain forecasts, which normally are more positive and also more bearish short term, as you can see in March last year, than what official forecasters do, which they only look at the eco side. Having said that, look at the ISM new orders. So it's a sub-par of the index. The main index was above 65. This is really more than acceleration. And the new orders is even reaching almost 70. Similar can be said for the export sector in Germany. That's the orange line. And to me, a bit surprising, but also the UK is almost at 63. So if you believe in such indicators as I do, the growth outlook has extremely brightened over the last 3 months. And it was already positive when we have last had this seminar. The key question, obviously, if you forecast, or at least if you try to assess what the economy is going to do, and then as an investor, where to invest, I strongly believe that sooner or later we will have an official announcement that the US recession is over, probably was already over in Q4 last year. Based on the bond markets, you see here 10-year yields minus 3 months and minus 2-year yields. So the steepening of the curve clearly indicates that the bond market, the US bond market, expects a significantly stronger growing economy down the road. What you also see in, or derive from it is that we have seen since December, roughly a 90 bips rise of yields. That's why government bond yields at the beginning were -4. But surprisingly, the US high yield market stayed positive. Why? Because of the expected growth. So a steeper yield curve in the actual situation basically means that the market participants and myself, we strongly believe that there will be an extreme strong growth ahead of us. Why? Obviously is due to stimulus. You have for sure heard that the latest US fiscal stimulus package has finally passed and the paycheck have finally arrived. So if we put the last 3 packages together, it is a scaring 25% of US GDP will be stimulated through fiscal stimulus, excluding, and I repeat, excluding the monetary part. This is really unprecedented. This is a huge impact. This will distort markets and it will definitely boost growth in the US. The expectation is that the US GDP might go as high as 8% this year, real GDP 8%, that translates to roughly 10% nominal GDP. Future will tell if that's going to happen, but with such growth figures, this has a huge impact on corporates, on the corporate side on bonds. So in particular, I'm talking of corporate high yields, and also on the equity side, which is lower in the collocation plan in case somebody would default. You see the rest of the world, major countries. Japan has a huge stimulus. France, Germany, Italy is surprisingly at high levels, given that normally they are doing austerity. And the key point is China does actually very little at the moment on the fiscal side and on the monetary side, because they are more advanced in the cycle. They didn't have a recession. They had positive growth last year. They have positive growth outlook this year, and they are trying to control the credit market. The key question is, does this money finally arrive to the consumer, and will it be spent? Because the first package last year mainly was saved and or invested into the stock market. However, it looks like, based on these indicators from Goldman Sachs released this morning, that various indicators for US consumer do indicate that we are now at pre-crisis level and at an acceleration speed. So the 1,400 stimulus checks people got, each person has finally found its way to the market. And that means that one of the things I kept saying over the last 24 months is we have a balance sheet recession and people are saving, be it private, be it corporate, and repairing their balance sheet. It seems now finally the fiscal stimulus is arriving and do its purpose, which is another point that probably the growth outlook from officials like IMF, OECD, etc., is by far too low, underestimating this impact and also underestimating the resilience of us as consumer, as producer. We have to adapt to the COVID situation. As you see, I'm still working from home. Nevertheless, I am now reaching levels of productivity I have had in the office without having so many meetings. So I would even say on top of working just with a laptop and not with a large screen and computer in the office, I'm now more efficient than before. And then just a little example, the economy is adapting, and that will be another surprise for growth down the road. If we look globally, so if we do the same analysis, how much stimulus is put in place, but in this time from global GDP, so it has basically the insecurity of what will global GDP be. So if we take the historical figure from last year, which is still an estimate, you see that globally almost 5% will be stimulated. If it's 5%, it's not really important. What's important is that almost all countries in the world are somehow stimulating by fiscal measurements their economy. And on the right-hand side, you see that the quantitative easing or the monetary stimulus is at unprecedented levels, and it's, at least from the four major central banks, still at extreme high levels and will last for quite a while. This will be shown in the next slide. So this is unprecedented, and both have obviously impact on markets, on outlook of growth, and obviously on inflation. Here you see a summary of what is expected over the coming months from the Bank of England, the ECB, in terms of purchasing of bonds. It is huge, it is massive, and you see even the Bank of England is going at least for another year roughly to buy bonds. The ECB is expected to do that till the mid of 2023 and might be prolonged. The ECB has indirectly admitted that they do what I call yield curve control. So basically, when they are buying bonds, they are tweaking it in a way that the spread of the 10-year government bonds of various Eurozone countries stays at muted level. This is one of the key elements of financial repression, which I have also talked about it several times and which I will come back some slides later. But the key message here is not only the Japanese central bank, but also the ECB does a yield curve control. If we turn to the Fed and compare it with the ECB buying program, this one is from T.S. Lombard. What we can definitely say that for 2021, the ECB is going to purchase more bonds than the Fed. If in 2022, the Fed is going to buy less than the ECB, I would make personally my question mark. But the key message here is the Fed is going to continue after having implemented this large stimulus package on the fiscal side, as well is monetary stimulus. A lot of people are of the opinion that this is probably too much. I agree with that statement. So this will boost profit. It will boost the economy, GDP, and asset prices, mainly of equity, but also of corporate bonds, in particular in the non-investment grade area, to higher levels. If you will, we can call it a bubble. The question nobody can answer is when it will burst. My educated guess is that for 2021, most likely corporate bonds are safe and the default rate is going to be much lower than what rating agency have forecasted last year for this year. If we turn to China, you see here for last year and also for this year, the total debt to GDP ratio in China is kept constant. What you have to know is that the Chinese GDP probably grows more than 5%, maybe 6 to 7 this year, and has grown more than 4 last year. So even if this figure is going to stay stable and is slightly restrictive, it is not completely, because the basis, which is the GDP, is growing. Therefore, debt in absolute terms is also growing, but the Chinese government doesn't want this figure to increase much higher. If we just take the traditional debt to GDP figure, you can see that China and like other emerging market, they are extremely healthy financed because they have a debt to GDP ratio of 65%. Having said all this, let's turn for a second to the market. Last year, in the worst time during the pandemic, the nominal 10-year government bond yield in the US was 0.5%. It went up to 1.77 just some days ago, and now is slightly down. The reason for that is an interesting one. There were rumors, and in the meantime, it was confirmed that the Fed is tweaking its bond purchasing program like the ECB and like Japan to the longer end in order to keep artificially low the yields of the 10-year government bonds. Once this rumor went over the ticker, the bond market, or the yield, let's put it that way, went down more than 10 bips and is now at the moment least trading around 1.65 to 1.7%. So the forward-looking rise of government bond yields, which we will see also in a chart in some minutes, is muted due to the manipulation of the central banks. Coming back to real yields and nominal negative yielding bonds, here is a chart updated, which I have shown last time. So the 10-year real yields adjusted for inflation in the US, even after the rise, is still at 66 bips negative. So if you buy treasuries and you take into consideration inflation and you exclude taxation on income, trading costs, etc., you already start to lose money in real terms. And that's why Ray Dalio keeps telling you cash is trash and government bonds should not be held at all. If we turn globally, and say what amount of negative yielding bonds are around, corporates and government bonds, mainly in pounds, in yen, in euros, SARS, and in Swiss franc. You can see that last time when we had this seminar, we were roughly at 80 trillion. Now we are down at 13.5 trillion, but this is still a huge amount. And here it's a kind of double whammy against bondholders. You start with a negative nominal yield, and even if inflation is low, there is inflation. So you end up even with lower real yields than in the US. And on top of it, on the income you earn, you pay taxes. With that, probably let's broaden up. This is a chart I used in the past. It is how I see the world. Last time I told you fiscal stimulus is the part which is missing. That's would be the medicine for healing the special situation of the balance sheet recession. This time I can say, actually, we have now also this ingredient working. And for the first time since the global financial crisis, you have fiscal stimulus, you have monetary stimulus, you have less pronounced balance sheet recession. Balance sheet recession meaning that private people do not save, they start to spend. We have seen that before, at least for the US, and corporates do a similar thing. You have negative yields in nominal and where not in real terms, and you have the last missing element, the yield curve control, not only in Japan and in the Eurozone, but also since some days we must say in the US during the Fed. And this altogether is a classical situation which in the literature you call financial repression. To come out of such a situation, you need to do fiscal stimulus, which is done at the moment. It will create midterm inflation. The question is how much. We are going to answer that in the near future. But what we can say already, it is an expropriation of savers towards the state in terms of we grow and inflate away our inflation, our debt problem. And having said that, that situation might last for quite a long time. I mean, last time after World War II, it took until the beginning of the 70s, and some even argued until 1982 when the Great Bull Run began and the yields started to decrease, and you had a tremendous rise in bond prices. So if I'm right, this situation will really last for a long, long time ahead of us. That also means that the yield cannot rise ad infinitum. It also means that inflation will be artificially manipulated. It can get out of control like in the 70s, but I would argue that most likely this is not the scenario which unfolds. So the Fed and Goldman Sachs, they have very similar forecasts. And I don't know how familiar you are with the US banking and government and treasury system, but there is quite, let's call it interconnection between all these various people and institutions. The key message basically is, and I agree with that, otherwise I wouldn't have put this chart here, that the most likely outcome for the next 4 years is that treasury yields will go max to 2.5%. That's quite a brave statement, and we might be wrong, but this is my strong belief at the moment. And honestly, I don't see facts yet which might put me in a more bearish camp. And if that is going to unfold, the answer, what will happen with inflation, is to a certain degree answered, because you cannot have, let's say, 2.5 yield of 10-year treasuries and 5% inflation in 3 years' time. However, JP Morgan, and in particular TIPS in the US, so the five-year forward-looking market or implied yield is telling us something else. So the break-evens for the 10-year are expected to be 3%. I said this last time, I repeat it this time. I believe it's too high. The market has overreacted. This chart is some weeks old, so the 10-year yield or the gap in between has closed. But if I am right, and we are going to see around 2% in the 10-year yield, so the blue line at 2, then the break-evens for the 10-year must come down to similar levels if there is kind of mean reversion. Here you see the same, but for 5 years. So the break-even, that's the orange line for 5 years, is at 2.5. And for the 10 years, you see it here again, it was at 3% roughly. I repeat what I said before. I believe that this is slightly too high. So the TIPS market is probably overreacting. People were probably buying too much inflation protection. That's the explanation of that. And you see that also in the two blue lines. One is the nominal and one is the real one. Both are slightly below their longer term average. I still would expect a certain pickup, but having said that, I also would expect the break-evens to come down below 2%. And then we are getting closer to what I believe might be a reasonable assumption of inflation forward-looking. Nevertheless, the Fed is basically watching the PCE GDP deflator. The Fed and the Goldman Sachs both say this year, due to technical reason, due to base effects, last year we had, for instance, oil crashing and other prices crashing, we probably are going to see short term in 2021 a slight overshooting of the 2% threshold. But we are not going to see a significant overshooting and down the road a falling or disinflationary environment. And that's why the Fed calls this transitory inflation. And you see that basically the assumption of both the Fed and the the Fed is that down the road in the next 3 years, the PCE inflation measurement is going to be around, at best, around 2%. And therefore, my humble assessment and conclusion is that the inflation outlook is not as bleak as you might have read over the last weeks and months. If I'm right, however, that has implication on the level yields, nominal yields might rise, and it has also implication on the outlook for bonds. If we start with bonds, for me, these last weeks were surprising because you saw a sharp rise in yields and you have seen a slight decrease of spreads. So spreads were tightening. The market was rallying in corporate bonds globally in the non-investment grade area. And I find this unprecedented and amazing. Although we have forecasted that, I'm still astonished that the spread didn't widen at all. It contracted. Excuse me. Forward looking, my best guess, and I must say guess, because at such elevated levels, at such levels we can even talk of bubbles. My best guess is due to the strong growth, we see a flattish environment for the spreads. Therefore, you should earn until the year end the coupon. If that's going to unfold after a positive Q1, the rest of 2021 will probably deliver for this part of the bond market. So we are talking of hard currency, dollar actually, bonds in the non-investment grade area. a positive return. Similar to equities, which is not a subject of today. And the key question is what's going to happen with investment grade and with government bonds. Given that we have seen a rise already of yields, probably we might see slightly higher yields. But if my forecast of the inflation might unfold, and knowing that the central banks in Europe and in America are going to buy longer dated government bonds to dampen the rise in yields, I have the hope that also on these areas we might see a slightly positive return for the year. If we are going to recover the -4% at the moment, I would put a big question mark, or I could even say I doubt a lot. But if you are not invested in such areas, at least the attractiveness of the asset class has slightly increased. Coming to the main topic, we, as you probably know, are heavily invested in Asian, mainly Chinese, with rare exception other countries, but mainly Chinese bonds in the corporate area. And we are also invested, but I would call it rather underweighted in the area of US high yield and other emerging market hard currency non-investment grade bonds. You see here on the left-hand side, the money market area, and on the right-hand side, you see the 10-year area. The spread between the two countries have narrowed. However, there is still in this market, so in government bonds and in short treasury bills, there is still a significant yield pickup if you were to invest in that area. It's not where we invest actually, but it sets basically the frame for the rest of the market. I don't know how familiar you are with the Chinese bond market. We are bond pickers, so we pick really companies, but the question is, where are we going to do that? I mean, if this were different lakes, you see there are 3 pots where you can basically invest. One is the offshore dim sum China credit market. One is the onshore renminbi market. Both are areas where we are not invested. I remember there was recently, in the last 2.5 months, a seminar from Cbonds about offshore local emerging market investments in Asia. It is an interesting area, but it's not our expertise. Where we invest is in the middle, in the offshore Chinese credit market. As you can see, since the global financial crisis, the market has significantly developed in terms of volume. What I find extremely amazing is this. More than 50% of the offshore US dollar credit market is in A or better rated companies. And then you have roughly 22% in triple Bs. So more than 75% of the Chinese offshore dollar credit market is investment grade. And only a minor part is in double B and single Bs. Our area of expertise is rather in the double B, triple B area, and I will show you 2 examples in companies where we have invested in the past. But for you as a takeaway, China is far away, but in terms of credit metrics, this is a sound market. This is a high quality market. And if you were just to invest in triple B companies, you can still have a significant yield pickup compared to other triple B rated dollar corporates globally. You see this here in a different way. On one hand, you see the investment grade spread pick up over the US in the blue line on the left-hand side, investment grade, and you see the similar for the emerging market. In the middle, you see China high yield which offer a significant higher spread than US high yield. However, this is mainly in the lower triple B, single B area, an area where we are trying not to invest. We are rather in the higher double B area, where the safety, the margin of safety, if you will, is slightly higher. This chart I have shown last time. I tried to replicate it. Unfortunately, the data for this JACI corporate double B Chinese index, the area we are mainly invested, is restricted, so I have no access. If I look at the yield levels, the general statement is still unfolding. So you get roughly 1 to 2% more yields. You get shorter durated bonds with shorter durations, and you will get a much higher yield to worst in these double B Chinese or Asian corporates than compared to the US high yields. With that, we come to a concrete example. I have brought you here on purpose two less risky companies. One is Country Garden and one is Shenzhen, if that's rightly pronounced. One is investment grade and one is high yield. And I compare them on purpose to, in brackets, similar risky investments on the US area. So one is Levi Strauss, which probably everybody knows. And the other one is the Marriott International Franchising Hotel Group. As you can see just from the title, in the Marriott area, you get a yield of roughly 1.9%. And if I compare that to Country Garden, I get, depending on obviously on the maturity, but with similar maturity, I get a yield pickup of at least 100 to 150 bips. The same holds true for the second one. So this is one of the largest real estate operator in China. You get a yield to maturity of around 4.5. And if I compare that to Levi Strauss of 3.5, in both cases of the American examples, I must add, they were distorted. The prices were at very low levels. So you could have bought them some months backward with yields 1 to 2% higher than where they trade today. That's really the disclaimer to these two examples. We like the companies. We have bought them in the past. However, given the actual yield level, it is really at your discretion if you get rewarded sufficiently for the taken risk. Nevertheless, the company metrics as they stand for the area, we find them attractive, but the yields in the US compared to the Asian opportunities put us more towards the Asian area. With that, I would like to hand it over to Jana, that she shows you, based on the Cbonds system, some concrete yield graphics, because the Cbonds system really allows you to analyze that.
Yeah, Andreas, thank you very much for the presentation. And now it is very interesting to compare those issues. I basically had a check with our bond screener, just the yield map of these issues. So comparing each one, so we see the Country Garden. I should say it's rather popular issue among everyone who invests in Asia. I think this is one of the most interesting cases. So the second issue, Shenzhen, we see it like this. So going directly to the developed markets, I think I don't need to explain. The yields are lower. And Levi Strauss, so even the long duration gives us not that much big yield. So it is rather interesting to compare in order to get general ideas. So I just put all your issues which you mentioned to the system, so we can see you were totally right. I think probably the Asia, the only market who now gives the decent ratio between the quality and the actual yield in order to beat at least some inflation and your expenses on all these executions. Going back to our seminar, I would like to ask our participants to leave questions in the chat so we could discuss a bit more about the questions which probably rolling into your head right now. As of my side, it is always interesting for you, for me to know better your vision as of today. The situation is dynamic, and the last weeks were rather volatile, well, in general. What is your understanding and feeling how the Asian market is dealing as of now? So it is the correction is on enough level as you expected. What kind of issues might be interesting to view, or what kind of sectors you think it is better to avoid now?
Well, the key question you raised, so is the correction over or not? If I look at indicators, I could easily say, yes, it's over, full stop. But this would be too short. I don't know how much you follow the COVID situation in countries like India and or Brazil. But given that in Brazil you have a second mutation, and given in India, the third wave over the weekend had a new sad record, which means that 100,000 new cases per day were detected, although more than 50% of the population had already the virus and was already ill. The scary question is, do you get a second time ill? The answer for Brazil is crystal clear. If you were to catch the mutated second version of the mutation, so not the original one, and if you were, extremely hypothetical, even vaccinated, you get ill. Disregarding if you were already ill, disregarding if you had a vaccination. And that obviously has impacts on the growth outlook. On the other hand, if you look at China, with their severe measurements, with their completely closed borders, it's very difficult to go there. And if you go there, you go 2 weeks in really quarantine, etc., etc. And they have now started to vaccinate before they have exported the vaccination. I would say I'm rather positive for China as a country. I probably can repeat that for South Korea. I might say the same for Japan. I'm extremely worried for India, and I'm also worried for Brazil, knowing that Brazil is in another continent. And in both cases, we really don't know until when this population get vaccinated and or a herd immunity. Although as a non-expert, so I'm not a medical doctor, but the little I have understood and learned is that basically the mutated version are in a way that you are not getting a herd immunity unless we get more than 80% of the population in each country vaccinated, and this is physically not possible in 2021. It is really having a drag, or it's the key risk forward looking. So, I mean, in China, you really have to go case by case. The largest sector to invest, that's why I had these two examples, is the real estate sector. There is a huge demand pickup during the lockdown, or recently after people bought new accommodation, larger ones. The financial situation is sound. But to make a general judgment is really difficult. You have to see at the new issues which come out and do your homework and decide case by case. Given that the service sector is picking up in China, I would argue that down the road there might be interesting new issues in that area. We are also sometimes invested in regional governments, quasi-sovereign bonds, in regional utility companies, but you cannot just generalize. You really have to pick it one by one.
So is it an issue to draw attention only to double B companies? Does it reflect the quality of the company as of now?
I mean, if I'm right with my growth outlook, obviously the default ratio in the single B area will be extremely low. Last time I've shown an estimate of default ratios for Asian corporates. If I'm not completely wrong, the figure was below 2%. Based from an asset manager, and it's much lower than what, for instance, Moody's has shown us last year. They were more at 5 to 7%, depending a bit on the region. So I'm not ruling out single Bs, but it would be very unwise just to recommend it. And sorry for repeating, but really it is a case by case to analyze the companies, to see the metrics, to try to understand the business model and try to understand if it's cash flow positive down the road.
Thank you. So we have a question from the audience. So does the fact that the corporate bond spreads have returned to pre-crisis level, but the debt levels are at the historical highs cause your concern, or do you feel that this is largely a reflection of the optimistic growth forecasts?
It's a bit of both. On one hand, I think it is fair to say I don't know any cheap asset, any reasonable priced corporate, be it on the corporate bond side or be it on the equity side. However, I haven't said it this time, but there are strategists claiming that we might see the roaring 20s. So first of all, technological change, acceleration of growth, and now on top of it, especially in the US, but also in other areas, boosted with fiscal stimulus and an ongoing bond purchase boost or monetary stimulus. So I would argue that for the next months, maybe years, this, what I would call bubble, and some call it the mother of all bubbles, or one calls it even the mother of all melt-ups, is lasting. You see that best in Bitcoins and other coins. How that will end, I said several times in the past, it will end in tears. So I'm really, how to say, happy with double Bs and not too many single Bs, and even this one might suffer. But all we know today, all the stimulus which is unfolding, and in some cases I would definitely agree, or at least state myself, there's too much stimulus, is giving you a certain time period where the music still plays. And the Americans call it a play musical chair, or dance as long as the music plays. The question is when this will burst. And the honest answer is nobody knows, which is not the answer you want to hear. However,
we are not.
I would argue for the next 12 to 18 months, hopefully, and I stress hopefully, it shouldn't happen.
We'll revert to this question a bit later, I'm sure, in our seminars. We have another question, a rather curious one, basically continuing our conversation about Brazil, but let's generalize it. And maybe you can share your thoughts on Latin American government bonds. Are there any interesting positions? And if we speak about long-term bonds, some investors tend to invest in, I don't know, like matured in 30 or maybe 40 years. So in any case, Just recently, these long-term bond prices, they significantly dropped with like 10-year maturities. So maybe you have some ideas or thoughts on the price fluctuations in really long-term bonds, whether they are safe to buy, or is it a good timing to buy them right now?
Well, this is more than tricky. If you are able to really monitor long-term bonds or 30 plus yearish bonds, they have corrected. And we do have some clients which trade them. And if you are willing not to buy at the bottom and sell at the top, it can well be that this kind of bonds might restart rallying. If you believe in that, obviously you have also to believe that equities rally, which you don't buy, but you have a similar return and a similar risk. So we are not investing in such bonds, but it is not completely stupid to consider it at this moment because we had seen a correction. What we bought is, for instance, roughly 10-year maturing corporate bonds in Mexico and Brazil. I mean, one example went from 108 to 96 and is back at 101. Such bonds we buy. I would continue to buy that. I mean, you get there a coupon of roughly 6 to 8% in that time frame. Yeah, and at the moment they are rather at the lower end, not knowing the future, obviously. But if spreads stay at current levels, you might earn a decent return and have an entrance around par. We would not buy government bonds, disregarding any country.
Yeah. Does it make sense for you to low a return?
I think the return is too low and the risk is too high. But yeah, I mean, I know there is, for instance, Bahrain, if I'm not mistaken, 2047. The bond has a decent yield, has a decent liquidity. The country has actually no rating, has had a drop. So if you were to play around, and this is another area, you can consider that, but it is definitely high risk. It is not just risk. So I rather buy equities instead of such a thing. And government bonds, for me, the yield you get is still too low, unless you really need the money down the road. But then I would do an asset liability mapping. So I would rather buy, if I need the money in 2 years, I buy a 2-year bond with a yield hopefully slightly above zero. But definitely 10-year treasuries at this level. So let's assume that this 2% is unfolding in the next 6 months. So you have roughly 40 to 50 pips rise with a duration of almost 10. Do the math, you lose money.
True. Well, this is kind of like the off of our regions, but speaking of Bahrain, well, I actively deal with Middle East. So talking about such countries as UAE or Saudi, for instance, this is a rather curious thing to think over how they will develop, because for instance UAE is almost open. They get back to their normality, I should say. I don't know whether they believe that everyone is vaccinated, and the companies start recovering their business, and Saudi has rather good quality as of me. What do you think about these issues, I should say, or markets? Are they attractive for investments?
Well, we have here an opportunistic approach. I mean, when there is a new issue, normally Sukuk bonds. Bahrain is a special case because it was a request from a client, so it is definitely not a recommendation. I find it interesting from the price movement, but the economy is recovering, as you just said, and if you are able to participate in the new issues, which we most of the time get an allocation, it is interesting. But again, I repeat myself, do your homework case by case and really diversified. I know this is boring, but believe me, if you're well diversified and one or two bonds crashes, the whole portfolio is still fine. If you, however, have two or three, let's call rather bets, and only one doesn't work out, your whole year performance is gone. And this is really, I know how boring it is, but I really urge you, buy rather 10 bonds than two big positions. You are most likely better off.
You don't need to explain me. I also have the same boring strategy, I should say, or the outlook, how it should be, but really hope that our participants have also the same strategy and study their issues really carefully in order to keep the general yields on a really good level. All right, then I would like to ask whether there are a few more questions regarding the fixed income market. So feel free to leave them in the section. So we'll discuss while we are expecting the questions. So what is your understanding how the Swiss is going? Everything's still locked. The business is still on the same really quiet level?
I mean, if you talk of the economy, it is twofold. I mean, people who can work at home are officially obliged to do that. But at the same time, if you look at the PMI data, which I haven't shown because Switzerland is small, but you see the same like in Germany. So our smaller companies who export, they have a PMI, if I'm not wrong, of 64, so extreme acceleration. We are extremely resilient, although we have what I would call a partial lockdown. I mean, shops are open, but restaurants are closed, cinemas are closed, theaters are closed. We have a huge help fiscal stimulus from the state that these companies stay alive. So they get basically money not to sack people, although some might not work. There is obviously a huge changement in the landscape of restaurants. A lot will or are already bankrupt. New ones are emerging. Overall, we depend on the global economy. So if my assessment of the global economy is right, and if in let's say continental Europe, although we are extremely late with vaccination, we get this done mostly till autumn, the future doesn't look so bad. But all burns down, are we able to hinder the new Brazilian version to come to Europe? Probably not. How much will it spread? Nobody knows. I mean, we had a politician who asked and said, let's close the borders for certain countries, e.g. Brazil, before we even knew that there is this second mutated version. The only country, to my knowledge, who really did that is Portugal. Probably no coincidence. They speak the same language and have a certain painful history. But in all other cases, you can basically travel from X to Brazil and back to X, and you don't even have to go to quarantine. You just need to do a test, and that's it. So it's only a question of time till this spreads over. And that's basically the big concern, and that is the big question mark to everything indicators can tell you. Because if the third wave gets out of control, which I do not foresee, but I cannot know it, then all I've said today, obviously, is maculatura, as we say. So, but at the same time, there is also hope, because a lot of vaccination is also arriving at our poorer countries. But this depends on the will of the richer ones to spread it, to share it, and not just to keep everything for themselves. Because there's a reason why America is so good underway. They have more people vaccinated than they had cases. It's rapidly rising. The same holds true for the UK and for Israel, which was basically the test country for the two American vaccinations. But look at the rest. I mean, look at Europe as an example. First, they have ordered not enough vaccines. Second, it's not delivered because these Anglo-Saxon countries keep it for themselves. So even if there everything works out, it won't save the world, because the mutated versions of the virus will infect people down the road. And this is the big risk down the road. And if everybody is honest, nobody can really know. And in Switzerland, we wanted to reopen 2 weeks ago. Our experts, scientists, etc., said, wait a second, if our forecast is right, we will see a much higher figure in 2 to 3 weeks. And today, as I speak, there's a press conference from our government, and the new figures are actually higher than they have forecasted 2 weeks ago. And that means that all the hopes for opening up restaurants, etc., is postponed.
Well, at least they were able to proceed. As we stated, the topic of our webinar more linked to inflation fears. Let's probably finish with really very interesting questions. So we have different types of the bonds, including inflation-linked bonds. So do they make sense in the context of potential inflation risk? Are they of USD-denominated bonds? Can you comment, please?
So if my forecast for the TIPS market, and I must say the TIPS market, there are also inflation-linked bonds in the euro area, which I haven't covered and honestly haven't looked at it for a while, then I would argue that there at the moment, the implied or derived inflation expectation is too high and the bonds are too expensive, like their pendant, their normal government bonds. I might be wrong, but the short answer to the question is the concept makes sense, but probably at the moment they are too expensive, at least in dollar terms.
So are they saving you, or it's not the cure?
What if you are really fearing inflation, you have to buy real assets. And TIPS are not real assets. They are probably the best in the bond area, but they are not real assets and they are expensive. And the rest, it depends on the development. I would say you won't lose much money if you buy them now, but I hardly see much upside potential at these levels.
Okay, understood. Everything is so expensive. That's very positive thing, but in any case, this is the reality we are living. All right, then I think we can finish with the questions on this point. I'd like to thank you for another deep analysis of the market and for your materials, so you could study and give us a bit better understanding of the inflation points and basically the movement of yields as of now. So I'm looking forward for our next session with you. Let's think over what kind of curious topics we can discuss. I would like to thank all our participants who joined us today. In case you missed some points, you feel free to contact us so we can send you the link to review it once again. In case you are looking for some interesting investments and trying to balance your portfolio, you're free to use our tools with the bond screener and double check those interesting issues which were mentioned today. So thank you very much for the session. Yeah, the next question I will probably answer myself. Right, the very last question. So we always have the seminars in this location in your room. Tell me a bit more about the artists who painted the pictures and the background. I was shy to ask for a year, but now I'm more bold.
Well, so if we look here behind this, in German we call it a gnome, so it's not a human being. was done from a local artist when we were in the mountain. The one there, the clown on the top, is a reproduction of a local artist, so it's not an original. The smaller ones you cannot see, but the smaller ones, no, I'm not able to.
Okay.
There. Oops.
Yes.
That is from Rolf Knie. Also that one under this huge gnome or dwarf. No, it's not a dwarf, but it's something in between human and non-human. It's also from Rolf Knie, but reproduction. The one there on the top is a local artist who was decorating a hotel we used to go for years. And we as guests, we always said, this is so great, can we have a copy of it? And then he did on purpose for the hotel guests a kind of series. So it's a signature copy of this artist. The one underneath is a local guy, really local from the next village, unknown, an original. He is not famous at all, but I liked it. And the one there was a present from a bank. It's also a reproduction of a local guy. We have other stuff like plates, etc. Basically, these are souvenirs of trips. That's the shortcut.
The last one is my favorite one. I thought these are just the diversification of your assets. Maybe, well, it would be a smart idea to.
I mean, if you are really rich and you have a lot of connection and knowledge, yes, art can be, and is at the moment definitely a place. I suppose you have followed various auctions recently. We were actually this weekend, Bensky, I think it's called. It's this guy who the auction was, and once the picture was sold, there came the shredder. We were at the exhibition of him, unauthorized. Yeah, it's amazing. The price increases. However, you have to be really a kind of timer, because some fashion gets out of fashion. Sorry, some art gets out of fashion, and then suddenly it is almost worthless. Same actually with carpets. You can buy expensive carpets, and if you keep them for 20 years, they might be worthless, or they might be tripled or quadrupled. You really don't know. So in my case, these are just souvenirs from trips, coincidences, like this one you like so much. It's exactly the point. We were in this exhibition, and this was the nicest one, and that's why we bought it.
Thank you so much for sharing your secrets. Thank you so much for attending it. I hope everyone enjoyed today's session, and join us and keep an eye on Cbonds. I think we'll make another interesting topics for the discussion. So feel free to drop us a line what kind of ideas or topics you would like to be discussed. Thank you so much, and wishing you a nice day.
Thank you from my side, and see you next time.